guys, welcome back to the channel. My name is Dave, and today we're doing part 5 of Option Basics. This is a playlist that I've created. You can go all the way back and start with number 1, but that playlist will be linked down below and here and everywhere I can place it. And you can go and start with part 1 if you're new to options and you want to learn and understand this. So this is part 5. We're kind of at the tail end of our first cycle of selling and buying puts and calls. So today I want to go through where we stand because this is Thursday in my world, 11/3 of 22, and our expiration is 11/4 at the end of the day on 11/4 after the market closes. So kind of want to touch base on all 4 of these trades and see how they've panned out. So if you watch part 1, 2, 3, and 4, it'll get you up to speed with where we are at as we come down to expiration day. So again, this is Thursday after market close. I'm going to take a look at each one of these trades and see, kind of where we sit now. Do we want to close it out? Do we want to wait for expiration? Just kind of talk through each position because I think that's really important to understand how these cycles work. So with that said, let's jump in and start looking at that very first one that we did when we first started talking about Coca-Cola stock, when we decided to write or sell that very first put. So in week 1, part 1, we decided to write or sell a put. We walked through that whole operation of how we write an option out. And we picked Coca-Cola as our underlying stock. The price was $56.02. That was back on 10/3. So we're about a month into this now with expiration tomorrow on 11/4. And let's remember, we sold a put contract, giving somebody else the right or obligation to put shares to us. So in this case, we decided to sell an out-of-the-money put at a $50 strike price, again with the stock at $56.02. Basically saying if it drops to that position, then you can put shares to us. In this case, we sold one contract, right? And that was worth 100 shares. So they can put 100 shares to us at $50. So we'd have to spend $5,000 to purchase those shares if it was to get assigned to us. But as time went along, everything kind of worked out in our favor, right? The stock price of Coca-Cola went up in value over the course of this month. So when we sold this option, we collected a premium on that first day of $35 and we put that in our pocket. Okay, and all we had to do is sit there and make sure we had that cash available, that $5,000 available. And we said, okay, so we understand our break even here is $49.65. And we felt good about this trade for 2 reasons, right? A, we thought, well, we're kind of bullish on Coca-Cola, maybe to neutral. And we want to collect that $35 in premium. Plus, we'd like the valuation at $50 a share. So if this was to fall all the way to $50, we're okay with it getting assigned to us. And we know our break-even calculation because we collected $35. We can just take that $35 away from $5,000 and then divide by 100 to get a break-even on a per-share basis of $49.65. So in other words, if we move this over and we said we're getting 35 cents per share on that premium times 100, we could take that away from our $50 strike price and quickly get our break-even of $49.65. So now, fast forward. Well, actually, we're current, right? 11/3. So we're almost at expiration here tomorrow, and the stock has gone up to $58.76. Again, we did this across earnings, and that's not always advisable if you're selling puts and you're trying to generate income, because that's going to add volatility. So it might give us the availability to collect more of a premium, but it also adds volatility and a little bit of risk to our trade. So we have a choice now. We can buy to close this option, or we can let it go to expiration. So right now, if I wanted to buy to close, if I wanted to go out and say, you know what, I sold this contract, I'm going to just buy and close it out right now, that premium would cost us $1. Okay, and here's a look at that trade. I'll flash it up really quick. You've seen this plenty of times, but if we wanted to buy to close this contract right now, we could do that. And it would cost us $1. Basically, we're closing out the contract, right? It's no longer exists in our eyes. It's gone. And for that, it's going to cost us $1. So if we did this right now, that means we would have made $35, but it cost us $1 to close it. So overall, we made $34. So the vast majority of our premium. And by doing that, we're de-risking the chance of tomorrow, the stock going from $58.78 down to under 50. So do we want to do that for $1? I wouldn't at this point. With it that far out of the money, I would probably just let it naturally expire. There's a couple of reasons for this. One, if I close that out with some brokerage accounts, they will charge you a fee to close it. So it might cost me $1 plus 65 cents, for example, to close out the contract. So why pay $1.65 when I'm highly confident that this will just naturally expire? So if it does expire, what happens? Well, I just wait around till it closes. The market closes tomorrow at 4 o'clock, and a little bit after that market closes, the option will actually officially expire, and I don't have to pay anything to watch that expire. And come Saturday morning, I'll have a little blurb on Fidelity or E-Trade or wherever it says option expired, right? It'll just show me that expired, and it will disappear forever, and I'm done. And I will keep all $35 instead of 35 minus $1 or $1.65. So in my mind, I would probably just wait in this case because I have confidence that the stock won't drop $8.78 tomorrow. So now let's move on to our next trade. A week later, we decided, or about a week later, we decided to sell our first covered call. And we said one of the important things here was the order of operation. So if it's a covered call, that means we have 100 shares of the stock and we're offering to sell it at a certain strike price by a certain expiration date. So in this case, we're allowing them to call away the shares, right? We're selling a call. They can call the shares away. We're giving them the right or the obligation that they can do that, if they the right but not the obligation for the person buying this call to do that. So with Coca-Cola at $54.51 now, we sold it on 10/7. We sold the open one call contract. In this case, our mind shifts a little bit and we're going to a bearish to neutral stance, right? We basically say we own 100 shares, but we don't know if Coca-Cola is going anywhere. So we're going to sell an out of the money call and collect some premium. And again, because we're thinking the valuation with getting to $57 is pretty rich, right? In that case, we think if it goes up to 57, maybe we just don't want the stock anymore. Whatever your thought process is there. And we picked the same expiration, and for doing this, when we sold this option, we get to collect $65 in premium at that moment. Put that in our pocket. Now, requirement in this case is no longer cash available, but it's actually those 100 shares. Again, if we don't have those 100 shares, it's a naked call. And when we're learning about options, it's important that we have those 100 shares in our pocket right now in order to sell that option to somebody else. So with the stock at $54.51, we go out and we buy 100 shares, which costs us $5,451. And now we can calculate what our break even is to the upside on this trade. So we would say our strike price is 57, and for $65 on a per share basis, that's 65 cents. So 57 plus 0.65 gives us $57.65. That's our break even point, where if it goes up to this, the option value is equal to the amount that the stock is appreciated in value past our strike price. So now, fast forward, or again, to today, 11/3 of 2022, and the stock is at $58.78. It went past our strike price. Oh boy, had good earnings report, right? So in this case, if we wanted to buy to close this option, right now on Thursday, at the end of the day, it would cost us about $180.65, and I will flash that order up here now so you can kind of see what it would look like on Fidelity if you wanted to actually place that order. And I think I put it in there as a limit order as well to get that at about $180.65. So is this bad? Did we lose $115.65 if we wanted to buy to close this right now? Yes, we did, because we collected 65, but it's going to cost us $180.65 to get out of this. So overall, we lost $115.65 on the option trade itself because it went well past our strike price. So horrible news, right? So what do we do in this situation? Well, we have a couple of options for this option. One, we could close out our option just like you see here, and we lose $115.65 on the actual option trade, but we still made money overall. Why? Because we bought shares at $54.51, and they are now worth $58.78, right? So the difference between those two numbers is about $425. And we lost 115, so we made about $310 overall, right? Because we still have a control of 100 shares of Coca-Cola. We lost on the option trade, but we made on the appreciation of the stock. And when we buy to close, we get to keep our 100 shares. Nothing will happen to those shares. They stay with us. So that's one option. Buy to close, lose on the option, but the fact that the stock went up, we keep that value ourselves. Now, the other way to tackle this is just to let it get assigned, meaning don't do anything. And if we For example, just hold this price tomorrow. If nothing changes through Friday till expiration, Friday evening, then the stock is still at $58.78. Well, guess what? It's going to get assigned, meaning that night, Friday night to Saturday morning, 100 shares will be ripped out of your account and you will no longer own them. That's fine because they're going to give you $5,700 for those shares, right? So you're going to see a credit in your account for $5,700. Sounds pretty good, right? Because you only spent $5,451 on those shares. So what do we make there? We made about $250 on the option itself. I'm sorry, on the stock appreciation itself. Plus, we keep our $65 that we originally sold this option for. So there we made about $315 or so, right? So we did well either way. So it just depends on, are you bullish on it or bearish on it? If you remember back, we said, well, we like it up to $57. So maybe that's the answer. We let it get assigned, let them take the shares, right? We offered to sell them at 57 and they're taking them now. And maybe we let that happen. We keep our $315 in overall profit. We turn around Monday morning and we say, you know what? I'm going to sell a put and I'm going to do this at, instead of 57, maybe 54 or 53. And I'll collect a premium again and I'll start this cycle up again. If that's our feeling about Coca-Cola. So both of these in this situation, we did pretty well by having the stock appreciate in value, right? We either kept the premium a little bit, not bad, or we collected the premium and we bought and sold the stock at a higher price. Either way, feel pretty good about both those trades. And we do have one other option here worth mentioning. I do not want to confuse you, so just jump past this section if you'd like, but I'll link a video up above if you're feeling pretty confident with this. It's all about rolling options, and once you get used to it, it'll make a lot of sense. So I will link a video up above here about rolling options. It'll go into more detail and give you some examples if you're feeling like you understand this content pretty well. But we could combine this buy to close with a new option where we would sell to open and do it all in one step. And that's called rolling an option. And if you look at your brokerage account, usually you'll have a little button there somewhere that says roll option. And it'll set up both of those legs. One leg means buy to close, where we spend that $180.65. You spend that money and you close it out. At the same time, you sell to open a whole new option out of further expiration. So right now we're looking at 11/4. Maybe we sell out to like the first week in December, right? The same strike price, just out further. So we close this one out and we offer to sell it out further down the road. So we would spend $180.65, but we would probably be able to collect maybe $380, right? Pocketing an extra $200 by rolling the option out, giving everybody the same right. They can still take it away from us. They can call it away at 57. I know, it's up to $58.78, but as you start to look at this information, it'll start making sense. So I'm just going to mention that here now, and if it's thoroughly confused you, that's fine. There's that video. You can kind of go to reference it, and I'll talk about it in a whole nother video that I'll add to this playlist. But just wanted to mention rolling options, so start understanding the language a little bit. Now, the vast majority of my trades, when it comes to options, are about writing or selling puts and calls. That's the lazy man's way to collecting some income by using a basket of money that you've already earned and putting it to work. And I found that over time, I can generate income this way. It's worked out for me quite well by selling these out of money puts and calls, okay, using these two techniques here. But buying a call, buying a put can also work in your favor, timed right. So I would say for me, it's about 95% here and just 5% over here. So in our third trade, we decided to buy a call. So let's run through this because this one worked out pretty well, right? Coca-Cola was at $54.98. We decided on 10/14 to buy a contract. Buy to open one call contract because we are bullish. Earnings are coming up. Pepsi had good earnings. We only need a few weeks to see if this will prove itself out across earnings. So we decided to throw our money down and make a bet, right? And this is a volatility bet. Meaning we think that volatility is going to be going up. We think the value of this option is going up in value because Coca-Cola is moving in the right direction, in this case bullish. So we're hoping for that big payoff in relation to how much we're betting. So with the strike price of $55, this is pretty much an at-the-money call that we are buying. We're only giving ourselves a few weeks, but it's across earnings. And for this, we get to throw down $160. That's our full bet. We're not out $5,000 or $5,451. We're just betting $160 in cash right now to buy that one call contract from one of these guys over here that's selling. Okay, so we have 160 bucks in this trade, and that gives us a break even of $56.60. That's easy for us to calculate, right? Because we know our strike price is 55, and on a per share basis, that's $1.60 per 100 shares. It's 160 bucks. So if I add $1.60 to 55, I get $56.60. So anything above that, at expiration, I make money, and anything below that, at expiration, I lose money, right? Because that's how much we have in the trade, and if we actually were to take assignment of those shares, this is our official break-even number, right? So now on 11/3 with the stock at $58.78, we have a couple options, just like we talked before. So first one is we could get out of this and get out of it right now. We could sell to close and take our profits. In this case, I'll show you the order here in a second. We make about $370. So I'll show you that right now. If we wanted to sell to close this, right now on the market, we could sell to close, get out of this contract, close it out, and we collect $370. Okay, so flash back over here. If we sold that for $370, we'd collect a profit of about $210, the difference between that $160 when we bought it and what we sold it for. So we made $209 for about $210. Pretty darn good. We more than doubled our money in that scenario. So that's what I would do right now. I wouldn't hesitate. I wouldn't even think about it. I would get out of that contract, take my money, and run. However, we have another option, which is, again, to take assignment of the shares. So we can do nothing, and we can wait till tomorrow afternoon, just like we did over here. And in this case, we're going to let them call it away. In this case, we're going to take assignment of the shares. So on Saturday morning when we wake up, all right, we can take assignment as well. In that case, we would have to buy 100 shares at our strike price of $55. So we would need to have $5,500 available to purchase those shares, and we would have 100 shares of Coca-Cola. Now, that's great for us, right? Because we're taking assignment of the shares, and it's worth $58.78, and we only have to pay $55. So if you're truly bullish and you want to keep the shares, you could do that. But it doesn't happen that often. Usually people are going to close it out, take the profit, and run. But if you truly want to own the shares, that's certainly an option. Just let it go to expiration, take assignment of the shares, and keep those shares, knowing that your basis in that is $55 plus the $160. So you're going to get to own 100 shares all in at $56.60, even though it's worth $58.78. You're off to a pretty good start because you're up $218 right now, just like that. So those are the two different options to run through. And you can kind of see that that math works out either way. So if you let this go to assignment, it doesn't change at all. You get about $218. If you just decide to close it out right now, the difference between that bid and ask, we probably need negotiated to be around that same value. So right around $210, $220 overall profit in this trade either way. But do you want to own the shares? Do you want to let it get assigned to you? Do you want to spend the $500 to buy those 100 shares? And finally, let's talk about buying a put. So a week later, we decided we were bearish on Coca-Cola, so we decided to go out with our final trade and buy a put. So again, Coca-Cola with it at $55.96. On 10/21, we decided to buy one put contract because we are bearish. This thing is going to go in the garbage. We want it to move and move fast because we need that big payoff. We need this thing to go in the dump so that the option premium value goes through the roof and we can collect that big paycheck. Okay, so we decided to buy, and at the money, very close to that $55.96, buy a $56 put. And we picked the expiration date that we've been picking, 11/4, which is tomorrow. And for this option, we had to pay the seller $120, right? This guy way over here, we had to give him $120 right now for this option. That's all we had to pay, though. We're only at $120. And that gives us a very interesting break even of $54.80. And how do we get that number? Well, it's quite simple. We've done this enough now, right? $56 minus $1.20 because we're looking at it to the downside here. So we got 56, $1.20 per share would be $1.20, or per 100 shares, $120. So 56 minus 1.2 gives us a break even of $54.80. Easy enough. Now, any questions on that, just ask down below. But today is 11/3, stock's at $58.78. So we decide to sell to close because we were pretty far out of the money at this point, right? We needed this thing to be well below 56, and it's all the way up to $58.78. So if we wanted to get out of this contract right now, the market's willing to give us a big whopping dollar. So in this case, we pretty much lost all of our investment. Unless some tragic news comes out tomorrow, we're out of money. So do you want to let your $1, I wish, I hope, I pray something could happen, ride, or you want to close it out? I don't know. It's a coin flip, right? Sometimes it happens. Sometimes people make a huge amount off these really, really cheap, out of the money options because tragedy does strike. But I wouldn't be betting on it myself. So maybe you take your dollar and you run. In that case, it would look just like this. I'll show you again here on Fidelity. Buy to close. It looks like they're going to give you one shiny dollar, and you could probably negotiate that. Somebody out there will probably give you that $1. But that's the case. So in this case, it did not work out. But, there are different types of trades that you can use here. So let's flash back over. If you look at our total gains across all of this, it's kind of interesting, right? Overall, we did 4 of these over the course of the week. We made $8.70. So kind of interesting, right? And if you look at the call option, because of the movement in the underlying, we made $209 here and we lost $119. So between buying a put and buying a call, right? In this case, we're playing bullish and bearish game. We made money overall. Pretty interesting, right? So lots of different ways to play options, but here are the 4 basic ones. And if you understand these 4, you're off to a great start. So I realize that this is a lot of information on this page. I hope it starts kind of fitting together for you, but if you have any questions on it at all, please just ask down below. I know for myself, when I started learning about option years and years ago, I started doing some small trades initially and got my feet wet. Yes, there's a cost for that type of education, but between reading books, watching videos, and doing some small trades, it started to all make sense and pull together. So again, I'm happy to answer any questions that you might have, and I'll continue to build out this playlist. If you want to see something specific, let me know. But we'll continue to create new content for this playlist as I go along. So again, any questions, ask down below. Appreciate you watching. Like and subscribe if you like this kind of thing. And we'll see you next time. Thanks so much.